Hey guys, I'm back. It has been a crazy time in the market. Crazy time at work too. So just been very, very busy, and it's been tough to balance both podcast, YouTube channel, as well as work and dad time. So I hope to get better at this, but I'm just glad to be back with you guys. I feel your pain and what's going on in the market. You know, my portfolio is down about 50% or so, roughly, after beating the market individually for the last 3 years. 2021 was really rough, and into 2022, much worse as well. So just stay strong. I encourage you guys to make sure you're really digging in deep and doing your due diligence, so you can actually make sure you earn that right and that conviction to keep those stocks and hold them. The market, ultimately it goes, I don't know, I actually got to go this way probably. It goes all the way up to the right. We've been through so many different challenges as a country, and bounce back. And so I think that we'll see that again. But what I wanted to do today is talk about Palantir and actually talk about earnings. And I know that several of my friends have already done that: Tom Nash, Amit, Cyberfam, but wanted to come across some different things here that I saw recently from analysts and stuff that just really didn't make sense to me from projections moving forward. So I'm going to try to keep this short and sweet, because I'm also going to record and jump on Amit and Chris's channel later tonight too, so don't miss that. That'll be live. So you can see here, this is Simply Wall Street. It's one of my favorite apps to use to analyze visually, looking at stocks. And with anything, you got to make sure to do your diligence, make sure you're looking at the 10Qs, 10Ks, and making sure you're understanding how the apps are getting the data. Simply Wall Street has a great YouTube channel, so they tell you how they get this data from SQ Capital. And so what jumped out when I pulled this up right off the bat was, normally Palantir has exactly this on the health balance sheet from the health graph, and there's 6 different outer rings that check marks that each category here has. I wouldn't expect them to score anything on a dividend because it's not a dividend stock. But normally they are really stretched all the way out here to future. And so that really just confused me, because nothing's really changed from the results that drastically. Granted, the revenue wasn't as maybe high as what analysts would like, but they had 31% year-over-year growth in revenue for last quarter. So let's dive in, and what really jumped out even further is that now they have their analysts forecasting only on the average for the next 3 years 26% per year. So they're not betting that Palantir can keep their 30% average consistent for the next 3 years. But based on a discounted cash flow of the most recent stock price, it's trading at 70% below estimated fair value. So we can obviously see here just so much volatility we've all endured. Just so you know, I did buy more shares. I didn't catch the full bottom, but at 750, I maxed out my Roth, and I'm glad I did for this year. And so we come down here, and this is what really jumped out at me was May 11th. There's actually now 11 analysts that cover Palantir, but 10 of them here said no longer expect the company to break even for the foreseeable future. So you click on here and you see, like, okay, what does that mean? So they're saying here the company was expected to make a profit based on their analysis of $52 million, essentially, if we round up, in 2024. Now, the new consensus forecast suggests the company will be making a loss of $25 million in 2024. So if you click in here, it'll take you to some great videos on Simply Wall Street on how they calculate all this, and what you should do when you see notifications on your companies around changes in their forecast. And so looking at that, I wanted to jump into the 10Q, but also come in here some other different pieces here. So we see that we did last 12 months negative 498 earnings, A lot of that is stock-based compensation, but we'll talk about that too. That also reduced in this past quarter fairly significantly from a year-over-year perspective. And we still had pretty high gross margins of 78%, down just a little bit. And then this is where we can see that discounted cash flow. You can click view data to see how they got that. But fair value at 2481 based on future revenues and cash flows. So we're going to go down a little further here. Sorry to make you a little sick. You can see here the company has plenty of cash on hand. $2.3 billion of cash, no debt. And they did do an extended credit line for another $500 million that they haven't touched in March of 2022. Their forecasted annual earnings growth is 52.8% annual moving forward. So we look here, and they're saying that by the end of this year, let me get it right here. By the end of this year, basically, let's call it negative $300 million in earnings from where we're at today in March. Last 12 months, 500. So we're going to go from 500 to 300. Now, when you look at the 10Q, and this is where we can start diving into another app that I really like, you can either just go to the SEC filing, which I would start there, but just for simplicity's sake of the font size and everything else we got going, we're going to pull up Koyfin. So Koyfin here, another great free app. They do have a paid version as well. So we pull up the income statement, and we can see the $446 million in revenue, reduced growth. I won't say very concerning. I'll say minutely concerning that, you know, we do see a decrease, right? But that decreased year-over-year growth is pretty typical when you look at building off of smaller numbers. What I like to see is that we are pretty much stabilized within that 30% range is what they've committed to. Which is still very substantial for a company of their size. And then we look at the cost of revenues, basically roughly around anywhere from 70 to 95 million. So it does make a big difference when they're, you know, on that lower end to how much gross profit they have in year-over-year growth. They were a little higher this past quarter at 94.4 million. If they can get it back down to that 87 mark and just hit the $470 million base case is what they said, underlying base case as far as what they are committing for next quarter, then that roughly puts them at about 383 million gross profit, and that would put them at roughly about negative 7 million on operating income. And so a trend that I do like to see is the operating income from all that stock-based compensation and adding of salespeople. We can see here, all right, now we're trending down, we're trending down. I like to see that trend, right? I want to see that positive operating income. And then something that wasn't really talked enough about, I know Tom talked about this, and maybe some others who cover Palantir have, but not everyone in the media has talked about why the lower margins and the bigger miss. You know, this is all from those SPAC investments and selling off those investments that haven't panned out. So I kind of look at it two ways. One, it's initial pain to now recognize these losses, but they also got those customers in long-term contracts. So if they can make those companies succeed and their share price eventually go up, they're going to keep getting that subscription revenue because those companies built their business on the Foundry platform. So we still have about 120 million left of SPAC investment that has to be sold off. I kind of have a hunch that why they estimated on the adjusted operating income margin to be only 20% next quarter, which would be the lowest it's ever been, is that they would just liquidate and sell the other 120 million and be done with it, right? And just take that loss, and in the back half, they know that they have much more revenue sitting there ready to go. So that's just a hunch that I have. But you can see here, you know, been fluctuating through the earnings and significant improvement from last quarter. Now we want to see another significant improvement, and that's what we need to really see from them. I don't like how lack of transparent, and I heard Tom say this too, of the earnings call and kind of the adjusted margins and where stock-based compensation fit in, and just the SPACs in general. It was really hard to kind of tell where revenues and losses were coming from and why the reduced margins. But there was also a lot of good stuff that came, right? So let's talk about that. We do see a little bit of reduction in some of these numbers here. The big one being the stock-based compensation. And we look at that from, last year at 193, now we're down to 149. We're seeing some very sequential growth. Now we're seeing a trend. So we want to see that come down even more. And we're pretty consistent on the research and development, and very consistent on the selling and marketing expenses, even though I feel like they've been out more in the public more than ever, which is what we want to see. So looking at that, I don't see, if they can keep the growth rates that they're at, how they could possibly not get to a net profit or break-even point by the end of 2024, even beginning of 2024, based on the trajectory that they're coming. They're assuming a continued amount of reduced revenue as well as margins. And if we look at the 10Q here, you go to, it's a great find feature here. You just type in remaining. I got this from Tom when we were looking at, he was looking at remaining performance obligations. You always want to see what contracts that they can claim as invoiced revenue once they complete the services. And right here's what Tom highlighted, and I'm just going to second it. They have 1.2 billion as of the end of this past quarter, and they are going to exercise recognizing 42% of that, which is $504 million in the next 12 months. The next 41% they're going to do within the next 3 years, or year to 3 years. So they really can over attain on that $2 billion run rate or projected forecast for revenue. And so if we pull this up, and this is kind of where I'll leave us. Just some other key highlights to look at. So we talked about the revenue growth. You guys heard from many earnings reviews about the commercial growth. The U.S. growth was also continuing to accelerate, which is great. And 37 of the 40 were commercial customers and growth there. But what people really didn't talk about, a couple things were, you notice they keep modularizing Foundry. These boundaries are going to keep going more and more as these specific things are delivered for specific use cases. When we talk about HyperAuto and CRM and digital twins and pipeline builder, then we look for Apollo doing the same structure there. And then Gotham is definitely going to continue to grow and evolve, especially over time with more investment there, but also government spending will open up eventually. So I think we've seen a lot of reduced government spending on defense, and we know that they're helping out Ukraine in the Ukraine crisis, and they will see recognized revenue from there too. So here's some of the net new products since public listing. So this is all modularizing their platform, Foundry and Gotham platform. One of the questions I did have on here was, said Apollo is enabling SaaS-based companies to rapidly deploy into sovereign clouds, and IL56, that's the highest rating when you go IL6 for government secure clouds and classified clouds, and into customer VPC and premise to expand market access. So if they're able to help deliver SaaS-based companies securely and their information and products into more secure FedRAMP clouds without themselves having to be technically FedRAMP, because it's basically encapsulated with the Apollo platform, which is IL6 certified, that would be a huge upside as far as more optionality just from Apollo alone, right? And we'll spend a whole section on the difference between autonomous deployment, continuous deployment. With developer, I should get CodeStrap on here to talk about the CI/CD pipeline and Kubernetes and microservices, because that's what this has to deal with, which is really a lot of the future of application development. And then I wanted to point out right here, we look at billings also grew very well, but the number of deals, this is telling me the sales team, the velocity is kicking up. We want to see this again Q1 2023, another 100%. And I believe still the average contract value is at least $7 million. So between that and between the 42% of revenue they're going to exercise, I find it hard for them to miss this $2 billion target for the year. And then if we look at the appendix, we got usage-based pricing, enabling IT to buy Foundry with a clear, transparent model that scales in predictable ways relative to usage and value. So instead of just a contract for the overall full platform, they've now modularized to certain products, and now they're having a pay-as-you-go pricing model, which is, I believe, very similar to Snowflake and some of the other software companies out there. I think that's a great way to get new customers to adopt your technology, because once they see the reduced time to value and the return on value in investment, they're going to expand on that. And that's where we see the contribution margins so high with Palantir, right? So it was 60% last year at this time. It's now 57%. Contribution margin is the amount of expansion in revenue a customer has year over year. And we know with the acquire, expand, and then scale phase of their business and how they treat their customers, it's really in that expand and scale when you start seeing those larger revenue contracts and margins. The other piece here is that it enables the GSI partners, which are the big partners like Deloitte, Accenture, those kind of consulting companies, to drive proof of concepts and trials and solution sets for specific problems for customers, and that then gets Palantir in the door. So there's more that I do want to cover, but I want to keep this short, which kind of really did 17 minutes now. So let's call it a wraps, and I will talk to you guys later tonight on the live stream. And glad to be back. I'm hoping I can get some more consistent videos out there. If you haven't hit the subscribe button, this will keep you up to date when I do post those videos. It helps me out with the channel, and make sure to hit the like button if you found this helpful. Thanks, and talk to you soon.